You can feel it again, can't you? That smell of fear is back in the markets. Now the headlines say, credit alarms are ringing. Really? Are we facing another credit crisis like 2008? Or is this just another excuse? Another wave of panic that the media and central bankers love to create every time the market gets too calm? Today, I'm going to tell you what's really going on in the credit markets and why, despite all the noise, I believe the panic is completely exaggerated. So buckle up, because I'm going to say some uncomfortable truths today. It's a warm day here, and maybe that's why I'm feeling bold, because today, I'm going to tell you some financial mischief. Let's start with what sparked all this noise. The governor of the Bank of England appeared before the House of Lords Financial Services Committee and said, with a straight face, that credit market alarms are going off. According to the Financial Times, he even compared current conditions to the pre-2008 crisis period. And honestly, that's quite a statement. 3 private credit firms in the U.S. have gone insolvent recently. Yes, that's true. 2 small U.S. banks were also hit by exposure to those same borrowers. Also true. But does that mean we're in a systemic credit meltdown? Absolutely not. Here's the thing. Politicians and central bankers will always find a reason to shout crisis. But we, the market participants, we don't have to believe it. So, let's go to the data, because numbers never lie. If credit stress were really rising, the first place we'd see it is in corporate bond spreads, the extra yield investors demand to hold corporate debt instead of government bonds. And guess what? Those spreads are not rising. They're actually falling. No uptrend, no panic. Number 2008 style spike. Now, let's look at the high-yield, junk bond spreads, which are even more sensitive to credit risk. Same story, a small uptick here and there. But overall, they remain in a downward to sideways trend. So, let me say it clearly. The data doesn't support what the governor of the Bank of England is saying. If anything, it suggests the opposite, that credit markets are stable, and that this alarm narrative is just noise. And here's something most people forget. When central bankers start warning about fear, it's usually a contrarian signal. They never warned us before 2008. They never told us before Lehman collapsed. They always show up after the storm, or worse, they become part of it. So when a banker suddenly tells you, be careful, credit markets are flashing red, I usually interpret it as, relax, the bottom is near. That's why I'm paying attention, not to what they say, but to what the data actually shows. As of October 2025, global high-yield spreads are still below 450 basis points, far from the 900-plus BPS we saw during real credit crises like 2008 or 2020. And corporate defaults remain low, according to Moody's and S&P data. So the so-called credit alarm narrative doesn't align with reality, yet. So yes, fear is back, but the charts don't lie. The market isn't screaming panic. It's whispering opportunity. You know what really surprises me? That a central banker, of all people, would say something like that publicly. They never warn us before a crisis. So when they suddenly talk about credit alarms, it usually means the opposite. They want to create fear, not prevent it. Let's check the CNN Fear and Greed Index. It's sitting around 26, deep in the fear zone. Whenever the market falls into fear like this, I know exactly what's going on. Investors start selling their winners, locking in profits, and running to cash. That's not rational. That's emotional. And that's exactly what I look for, because according to contrarian theory, when everyone's scared, that's usually when markets go up. In behavioral finance, this is what we call the pain of loss bias. Investors feel twice as much pain from losing $100 as pleasure from gaining it. So even small declines trigger panic. It's classic. Fear spikes, volatility rises, and those who were too late to the rally start selling just as the smart money begins to buy again. So right now, I'm not seeing panic as a danger sign. I'm seeing it as a buying opportunity. Now, let's compare this with 2008, the moment everyone fears most. Back then, bond spreads, both corporate and high yield, were skyrocketing. Investors demanded huge premiums to take credit risk. Spreads doubled, even tripled in some cases. Look at this. In late 2007, the U.S. corporate bond spread started climbing sharply. And by mid-2008, it was exploding. Same for high-yield bonds, from 250 basis points to over 1,000 in less than a year. That's what real credit panic looks like. Now, in 2025, we're nowhere near that. Corporate spreads are below 150 basis points, and high-yield spreads hover near 400 to 450, a level typical of normal market corrections. So no, this isn't 2008. This is noise dressed as drama. With all due respect to the governor of the Bank of England, he's wrong. And honestly, when central bankers start sounding like doomsday prophets, it usually means one thing. They're trying to prepare excuses in case something goes wrong later. But in the markets, we trade facts, not fear. And the facts show liquidity is still abundant. Credit stress is low. Fear is high. That's a perfect cocktail for the next leg up. As of October 2025, U.S. high-yield default rates remain around 2.3%, according to Moody's, well below the long-term average of 4.1%. In 2008, that figure peaked above 14%. So anyone comparing the current market to 2008 is either uninformed or pushing a narrative. So here's my conclusion so far. The only alarm I hear right now is the one ringing in people's heads. Because fear sells headlines, but data tells the truth. Now, let's look beyond the fear and into the real driver of everything that's happening behind the scenes, liquidity. Because if we understand how liquidity flows, we understand why markets behave the way they do, no matter what the headlines say. Visual, animated global map with lines representing capital flows. Overlay text, $38 trillion U.S. public debt. Let me show you something that almost no one talks about in the media. U.S. public debt has now surpassed $38 trillion. That's a new record high. Governments around the world are spending like there's no tomorrow. And here's the key. For that gigantic debt bubble to not explode, there has to be enough liquidity in the system to keep it rolling. Because every day, billions in government bonds mature, and they need to be refinanced. If there isn't enough liquidity to absorb those issuances, then you have a credit crisis. But that's not what's happening. Liquidity is still growing globally. Look at this chart. Global M2 money supply is still in an uptrend, reaching new all-time highs. And that's not just the United States. China's central bank, the PBOC, continues to inject liquidity into its banking system. In September alone, it added nearly 900 billion yuan through medium-term lending operations. That's over 120 billion US dollars of fresh money. The European Central Bank, despite its tightening rhetoric, has quietly stabilized its balance sheet too. Translation: the world is still swimming in money. Here's how this works. Governments issue debt, central banks ensure liquidity, financial institutions buy that debt, and the system keeps turning. It's a self-sustaining mechanism until confidence breaks. But we're not there yet. So when you hear people talking about the bursting debt bubble, remember, as long as liquidity keeps expanding, that bubble won't burst, it just keeps inflating. So let's summarize this clearly. Public debt keeps rising, $38 trillion and counting. Liquidity keeps flowing. Global M2 is at record highs. And central banks, even when pretending to be tough, quietly ensure the system doesn't run dry. In other words, the engine of the market still has fuel. That's why, despite all the noise about credit, inflation, or geopolitics, equities remain resilient. The real risk won't come until we see a genuine liquidity contraction, not just a few scary headlines. According to the IMF's October 2025 Global Financial Stability Report, global liquidity conditions remain accommodative, with total central bank assets still 35% above pre-pandemic levels. That means, structurally, there's still enough money to support both debt and equity markets, which explains why sell-offs keep getting bought. So when I hear people shouting, the debt bubble will explode, I think, not yet. Because the system doesn't implode when people expect it to. It implodes when nobody's watching, and right now, everybody's watching. Now, let's connect the dots. If global liquidity keeps rising, and fear is dominating investor psychology, then the logical question is, what happens to the stock market next? Every time fear spikes, investors dump the same stocks that made them money, the leaders, the momentum names. And that's exactly what's been happening lately. When fear takes control, people sell Apple, Microsoft, Nvidia, Amazon, not because they're bad businesses, but because they're profitable positions. It's human nature. They sell winners first. But here's the paradox. Those are usually the stocks that lead the next rally once the panic fades. That's why, when I see the fear and greed index down near 26, I don't panic. I get interested, because that's where opportunity hides. Let's add another layer, seasonality. We've just come out of the weakest months of the year, September and early October. And what comes next? November and December, statistically two of the strongest months for the S&P 500. Historically, over the past 50 years, the S&P has risen almost 75% of the time during the last 2 months of the year. So if you combine seasonal strength with high fear and ample liquidity, what do you get? The perfect setup for a continuation of the bull trend into year-end. I know it sounds counterintuitive. People see red candles and panic. But from where I'm standing, the market is simply shaking off excess optimism and preparing for the next move higher. Let's be clear, the fundamentals haven't changed. Corporate earnings are holding up. U.S. liquidity is stable. The global economy is slowing, but not collapsing. So, based on sentiment and liquidity flows, I still believe the S&P 500 can keep rising into the end of the year. Corrections? Sure. But in the bigger picture, the bull still has fuel. As of October 2025, more than 80% of U.S. companies that have reported Q3 earnings have beaten expectations, FactSet data. Liquidity conditions remain stable, and the Fed's reverse repo facility still holds over $1.2 trillion, meaning there's no cash shortage in the system. That's why, despite all the fear, institutional money hasn't left, it's just repositioning. So here's my honest view. When the media says fear is back, I say thank you, because fear is the fuel that powers the next wave higher. Liquidity is abundant, debt keeps growing, and investors are scared. That's exactly what a bull market needs to keep going. So, as strange as it sounds, I'm not afraid of fear. I'm buying it. All right, now that we've talked about fear, liquidity, and the stock market, let me tell you something that's been flying under the radar. And it's a story that could reshape the global economy. A few days ago, the Wall Street Journal reported that the U.S. administration is considering taking stakes in quantum computing companies like IonQ, Rigetti, and D-Wave. And that's not just another headline. It's a clear signal. We're not just in a trade war with China anymore. We're entering a technological war for dominance in quantum computing and artificial intelligence. Why does this matter for us as investors? Because when technology becomes a matter of national security, governments no longer act as regulators. They act as investors. Back in 2018, the U.S. passed the National Quantum Initiative Act, a law that allows federal agencies to directly invest in quantum technologies. So if you think these new moves are spontaneous, they're not. They've been planned for years. And now, with geopolitical tension rising, this tech arms race is intensifying. The U.S. wants control over the next generation of computing, because whoever dominates quantum computing will control encryption, defense systems, AI, and global finance infrastructure. So here's the irony. They tell us that AI is in a bubble, that it's overvalued, that it's speculation. I disagree completely. The real risk for companies today is not investing in AI, because if your competitors adopt it before you, you're finished. That's why I believe we're not at the end of the AI cycle. We're at the beginning of the exponential phase. And yes, when governments start buying stakes in AI or quantum firms, it tells me something very simple. This technology is no longer optional, it's strategic. Now let's connect that with something more classic, gold. If we add up the gold stored in London's LME vaults and in COMEX in the US, we get roughly 9,000 metric tons. But not all of that is available. Much of it belongs to central banks and institutional clients, meaning it's already allocated. My estimate? Maybe 200 tons are actually free-floating. That's it. Now, compare that to the paper gold market, all the gold derivatives and contracts traded worldwide. For every physical ounce of gold, there are more than 200 ounces of paper gold circulating. See the problem? There's simply not enough physical gold to back the system if everyone decided to take delivery. That's why the BRICS countries are getting nervous and why they're asking for their gold back. And here's where it gets even more interesting. While everyone's panicking about credit and debt, BlackRock quietly bought over $200 million in Bitcoin last week and another $40 million in Ethereum. Now, ask yourself, are they buying because they're afraid or because they know something we don't? I think we're watching a transfer of wealth. From retail panic sellers to institutional accumulators, Bitcoin is slowly becoming the digital version of gold. And with liquidity still abundant, it's only a matter of time before both gold and Bitcoin start trending higher again. In 2025, institutional crypto holdings have reached an all-time high. BlackRock, Fidelity, and ARK collectively manage over $25 billion in digital asset exposure. Bloomberg data, October 2025. Meanwhile, gold ETF holdings remain near multi-year lows, a classic contrarian signal. So here's my last maldad for today. Maybe the alarms aren't ringing in the credit markets. Maybe they're ringing in the monetary system itself, a system that's drowning in debt, addicted to liquidity, and quietly preparing for its next transformation. From paper money to programmable assets. If that doesn't keep you awake tonight, it should. If you want to keep following these kinds of deep dive analyses, where we go beyond the headlines and uncover what's really moving the markets, make sure to subscribe to the channel and like this video. It helps more people find this content, and it tells the algorithm that you value truth over noise. See you in the next one. Stay calm, stay informed, and stay ahead of the herd.